Hi, everybody. Good evening. Oh, not yet. Don't think we're up. Hi, everybody. Good evening. Welcome to Endowus's Access live webinar of Meet the Experts. Thank you for your patience. We've had some technical difficulties. We're trying to get Joel Kim from Dimensional on. We've had some video difficulties. So we're still trying to fix that problem. So we'll welcome Joel very shortly, but we thought that since people are waiting, we'll get going. And today's webinar is about Meet the Experts, Unlocking Dimensional's Nobel Prize winning factors to investing success. And I'll go through a few slides and welcome Joel when he is ready. And so we are gonna test out.
I can hear you, Sam, but I'm getting on my iPad right now, so you can at least see me.
Also, that would be fantastic. Okay, so you can actually turn on your video because we only have one video at a time. So the speaker will be highlighted. And then when you sort out the iPad, then we can switch over to your iPad.
Perfect.
So first of all, let's say hello to everybody, the audience. So thanks, Joel, for joining us today. And we're really excited to have you here today.
Thank you. As I'm speaking, I'm still trying to get on. So I'm going to pass it back to you, Sam.
Okay, we have a beautiful dimensional background in the meantime.
Yeah, you will have to do with my face at one point.
And in the worst case scenario, Joe, we'll have you as audio because we'll have the slides as the main picture anyway.
Yeah.
So let's try the iPad option. But to our audience, thanks for joining us. Please be patient with us as we sort these things out. But Joel's here, don't worry, and I'm here to get this going. So today's topic is obviously on unlocking Dimensional's Nobel Prize winning factors to investing success. Endowus has a regular webinar, as you know, every Wednesday. And we've had wonderful speakers in the past from the blogging, financial, investing community, as well as people like Lou and also Dimensional, our partners, and other fund management companies. So please click below and subscribe to our YouTube channel, and you'll be regularly updated on any changes. And we're introducing a new series called Endowus Access. And today we have Joel Kim, the CEO of Dimensional in Asia ex-Japan. He's also the head of fixed income in the international side, ex of the US. And he leads the teams that manage, multi-billion-dollar, funds across the region. So we will talk about Dimensional, introduce Dimensional, and also how they invest, their investment philosophy, their history. And we'll also focus a lot on the fixed income side, where Joel has tremendous expertise. He was previously the head of fixed income Asia Pacific at BlackRock and has a wealth of experience in the industry. So the right speaker for us tonight. And the Endowus Access series is really about hearing advice and insights from the experts. So people who have actually managed money as investors. And so we're really excited to start this new series and really learn from institutional investors who are professionals, hear from them about how they invest and what the philosophy and investment process is at their respective fund houses. So we're really excited about that. Just a quick intro on Endowus. We are here to solve the problems of investing, which is a really painful experience here in Singapore and across Asia. We've built a wonderful team. We're up to about close to 40 people now who have deep experience in the industry, in finance, in technology, and also we have people who are experienced in building advice, providing advice as well. So we built a digital wealth platform that is the best in class. Provides really aligned, independent advice, which is in the best interest of the clients. We give access to wonderful products at low cost. So we really are about helping people invest better, to live easier today and live better tomorrow. We intentionally focused on the most important issues of finance, such as retirement. And in Singapore, to do retirement, you cannot leave out CPF. So we worked very hard with the CPF board, MOM and MAS to introduce CPF investing digitally. So we are the first and only digital advisor for CPF. And as a result, the only digital wealth platform where you can manage your CPF investing, your cash investing, and your SRS all in one place, holistically, conveniently, and with expert advice. And we care about a few things, as I mentioned: advice, which is really important, being strategic, passive asset allocation to reach your goals, not trying to time markets or trying to beat the market, but really trying to do the right thing to build wealth over the long term. And I think that access is really important and critical, because investors don't have access to the best products out there, and so that's really important for us. And also cost, reducing cost at every layer. So with that, I'm gonna also introduce the Slido poll. So if you go to Slido and you can click on the link below on the YouTube channel as well, if you type in 62151, you can go to the Slido page where you can start asking questions, and you can also upvote the questions that you feel are really good, so that we'll get to the best questions and the most popular questions first before coming back. So we'll have Q&A session in between and also right at the end of the presentation. And with that, we're going to go into the presentation. Joel, I see that you have joined us on video too.
Hopefully you can hear me now and see me as well.
Yeah, fantastic. Thank you so much. All right, fantastic. So we're going to move forward, and we launched a new article on insights. We've attached the link to the bottom of the YouTube channel, so clients can directly access at the end of the webinar. But we've launched the dimensional portfolios, 100% dimensional portfolios. Two different portfolios. One is multi-fund, which uses 3 different types of dimensional equity portfolios to build a diversified, holistic, and slightly lower volatility and lower cost portfolio for you to gain globally diversified exposure. And then the single fund option is the World Equity Fund, which is the broadest, most diversified single equity fund in the world, I believe. And Dimensional runs it exceptionally well, very efficiently, and that's a simpler version, but it has also slightly stronger tilts towards value and small, and therefore has underperformed slightly the diversified portfolio that we have. The fixed income part is made up of the core Dimensional Global Core Fixed Income Fund, which is the flagship product. That is, Joel oversees the team that manages the fund, as we explained earlier. And so you can build a target risk portfolio based on your own personal circumstances and needs. And you can go to directly the FundSmart platform, select general wealth accumulation, select your source of funds. Obviously, Dimensional is not yet available in CPF, but you can ask Joe later when that's coming. But $1 cash and SRS investments are available, and you can build the portfolio depending on the ratio that you are suitable and comfortable with. This is a 60% 3-fund equity exposure plus a 40% exposure to the global core fixed income. And with that, you get a whole series of analytical tools that immediately builds the portfolio, its historical returns, historical performance, forward simulations, and more details and full transparency on fees when you build that portfolio. And this is the beauty of the FundSmart platform, that you select the different funds and the ratios, and immediately it will rebuild the portfolio as a whole. So I think that this FundSmart platform is really exciting and something that we can use. And the long-term performance, obviously, of the Endowus advised portfolios and the dimensional multi-fund portfolios have been exceptional, beating the index over time. And so these are portfolios that we've tried and tested. We built it in the right way, and we now have Joel Kim live with us with a proper dimensional background.
Hopefully you can still hear me as well.
Yeah, so maybe we mute the iPad because now you're on computer. Yeah, it's fantastic. Great. And so we'll have dimensional slides coming up shortly. And if you give us 1 second. Yep, we are ready. So Joel, I'll hand it over to you, and we can share the slide and an introduction to dimensional.
All right, well, we've had a bit of a hiccup, but we can get going now. Thanks very much, Sam. You already introduced me, so my name is Joel. I want to start with thanking you, Sam, for inviting us to explain what we do. The relationship that we have with Endowus goes back to 2017, before you guys actually got started. So we already had the dialogue with you. And yeah, we absolutely value the partnership, and happy to explain a little bit more about what we as Dimensional deliver to your clients. And yeah, let's start with actually explaining a little bit about the background of the firm and what the foundational concepts are that we use when we invest, when we deliver investment solutions to clients. So first of all, we manage over $500 billion in assets across a range of global strategies. I think what is unique about the firm is that we've gotten to that size by growing organically. So basically through word of mouth, to a very large extent with clients like yourself that have grown along with us. And the other thing that characterizes us is that we've done that using a single philosophy. As you know, Sam, we've got a particular view on markets and what we think you can use to deliver good client solutions. And so over the next hour or so, we'll talk a little bit more about what exactly that means. So if we then move to the next slide, and we talk about what shapes our investment philosophy and how do we implement it. All comes from the findings of leading academics. So we've got a couple of them shown here in the slide. You already mentioned some of them, Sam. Eugene Fama, Nobel laureate, Robert Merton, Ken French. So all these academics have shaped the research and the research agenda at Dimensional. And that on itself has provided a bedrock for how we invest. But it's also been instrumental in terms of shaping the company's culture and the DNA of the internal investment team and the processes that we apply to get to the solutions that we offer to clients. So if we then move to the next slide, roughly 2/3 of our business is devoted to supporting and servicing financial advisory clients like yourself all around the globe. And here in Asia, actually Japan, we do that out of the Singapore office, which is the largest office in the region. It's full service. We do portfolio management, we do trading, and we service both advisory as well as institutional clients through the sales teams that we've got on the ground. So we're here committed to the region. We're here for the long term. So if we then move to the next one, we address the question why Dimensional? So we at Dimensional believe that there's 4 key pillars that we believe that differentiate us. It's philosophy. I already mentioned a little bit about it. It's how we believe markets work. And the implication of that trust in markets is that we believe that security prices offer real-time valuable information that you can use to beat the markets in a way. And so we're here in the game to outperform. The second part is about implementation. So while our approach is rooted in academic research, in a way you could say that research is available to everybody, academic research. So it's all then about weeding through all the different claims and then understanding what you can actually use to harvest the premiums that we pursue in real portfolios. So at the end of the day, both matter. Having a sound conceptual framework founded on your investment philosophy, but then understanding how you can implement that obviously matters too. And the third part is body of work. So think about, our 4 decades of actual delivering solutions. We consider ourselves as pioneers in the factor space. So we know all about it, and more importantly, we've actually shown it in real solutions over those 4 decades. Last but not least, it's a commitment to the client experience. So that's very important. This is all about earning trust by setting client expectations and meeting these expectations. So Endowus, you have partnered with Dimensional because both companies believe in providing a positive investment experience to our end clients. So Dimensional tries to achieve this by not speculating with your client's money, but by trusting in the power of markets. So if we then move to the next slide. So when we talk about, and skip this one, please. So when we talk about what sets us apart, obviously investors have many different choices to invest. And we start with a couple of approaches that are probably well known. So traditional active investing. And we, in this way, consider like quant investing as part of like active management. In a lot of cases, rely on predictions, or in when you think about quants, on backtested simulations to find essentially mispriced securities, or what you essentially try to do is time markets. And the assumption that you then make is that markets don't function efficiently, and there's frequently mispriced securities. So essentially, when you believe in that approach, managers search for those mispricings, and you make bets on when you think the market doesn't have it right. Now, I don't want to completely dismiss this. Sam, you know a little bit my background. You've already mentioned it. I spent quite close to two decades investing that way. But there's a couple of challenges when you talk about active investments, and we'll address that a little bit further in this presentation. Now, the second part is that you can say, well, I don't believe in any of that. Why don't we just buy market portfolios? You go for a passive indexing approach. So on itself, there's nothing wrong with that, but there's some disadvantages there as well. The most simple one, that you will never be able to beat the benchmark, because even passive investing is going to come with costs associating with managing those strategies that way. So in short, there's pros and cons to those two traditional approaches. We believe that there's a third way that you can invest, active, but then without trying to outguess the markets, but using the information contained in security prices to deliver solutions that can still outperform the benchmarks, but at the same time are very well diversified. We offer them at low cost. They're very transparent. If you understand what we do, you know what you're going to get. And it's highly scalable, and that contributes obviously to the cost efficiency to what we can deliver. All right, let's move on to the next slide. So just a couple of illustrations, and you will probably have seen this before. This is our way to show, like, yeah, how do active managers on average do? And the point that we're really making here by trying to outguess the market over different periods, there's not that many managers that actually are successful in beating the markets, outperforming their benchmarks, especially net of fees, and that are able actually to survive over longer periods and still be successful. Okay, so if we then move to the next slide. And this is something that you will completely agree with me, costs matter. So this is our way of showing that the more you charge for a solution that you offer, the more difficult over the longer term it is going to be to deliver that positive investment experience to your clients. And so this is really the issue of delivering okay growth performances, but what exactly is left for the people that actually invest in your funds. So if we then move on. And then I'm going to finish on this particular topic. So this is another aspect. Yeah, you can have it right now and you can be successful. But to what extent are successful managers still successful over the longer run? So the winners over the last 5 years, in a lot of cases, are not necessarily the winners over the next 5 years. So we show this for equities. We'll have a couple of like similar slides for fixed income. As you know, my background is fixed income. We start for the next 5 or 10 minutes where we talk a little bit more about equities, but then we'll move on to how we invest in fixed income, and then we can talk a little bit more about like actual experiences that we've had, particularly in the beginning of the year, and hopefully that explains a little bit about like not only how we approach delivering returns, but also how we manage risks and how we manage the cost part.
Yeah.
Okay, let's
Thanks,
move
Joel.
on.
We'll move into fixed income, and then we can, in between, talk a little bit between ourselves to make it interesting for the audience. So maybe focus on the initial, fixed income charts, and then we'll talk about the more interesting stuff.
Yeah, so as a matter of fact, quite quickly when we go into the fixed income content, I will address some of the questions that you actually asked me. So I'm like, what was your experience? So I promise you we'll definitely address that. This is the last bit that I will say about like the difficulty always about always getting it right in the equity market. So this is a very simple illustration that where in the vertically in the columns, we show like what the markets were that had the highest returns and the lowest returns. And then we look at calendar years and try to find a pattern there. The bottom line is it's very difficult to find any pattern. And that's exactly what our research shows. It basically underscores it's not difficult to like be able to outperform based on constantly getting, identifying what the best markets are going to be. All right, let's move on. So when we talk about like what it is that we do at Dimensional, and what does more than 50 years of academic research as well as our own internal research show? And then we start with like what is our understanding about what drives returns and what drives expected returns in stocks and bonds. So as we know, securities should normally have different expected returns. And what we believe is that the prices contain reliable information about the long-term performance. So in short, the science that we use indicates that there are certain factors, so we call that dimensions at Dimensional, so hence the name of the firm. A certain number of factors account for the majority of the expected returns and the return differences across both equities and fixed income. So those dimensions you can achieve, we can achieve that not by just speculating money, but by trusting in the power of like the markets and like what the information that they offer. Now, let me explain that a little bit further when we go to, so for equities, we generally look at, for example, company size, relative price, and profitability of companies. So what leads from that is generally stocks from companies with a smaller market capitalization and value stocks and profitable stocks typically drive higher expected returns in equities over the long term. Now for fixed income, we've got term, credit, and the currency of issuance as the long-term drivers of returns in fixed income markets. Now these dimensions, how we call them, of higher expected returns, are persistent and pervasive. With pervasive, we mean that you can apply this across markets globally. And persistent means that throughout time, it's proven that this works. Now, the last thing that is important when you think about this way of investing is that what works in theory and in your backtest also needs to be implementable in real portfolios, and that you can implement this again in a cost-efficient way. Now let's have a closer look at like how do we actually do this in equity portfolios. So if we then move to the next slide, how do we apply those principles? Now the starting point is that we start with the market. When we look at a global portfolio, we obviously have the opportunity to invest in many markets. So the first idea is own as many stocks as you can in a given market, because by owning a very well-diversified portfolio, you essentially reduce idiosyncratic risk. So that's the baseline. You use market cap weights, so to make sure that you have all the available stocks that are out there, sometimes even more, before you start with trying to outperform the market. Then we move on. So once you have that baseline of the market, then you can think that you can imagine that you have that portfolio, and imagine the portfolio looks a little bit like an ice cube tray. We tilt that tray so that we overweight, for instance, small cap, value stocks, underweight large growth stocks. And by reducing your exposure to what we feel are lower expected return stocks, so large growth companies, you basically tilt the portfolio towards the rest of the market that we expect to deliver higher expected returns. Now, why is this important, and does data actually show that that is a wise thing to do? So if we then move to the next slide, you look at basically the long-term relative performance of small, value, and high profitability relative to large growth and low profitability in the US, in developed markets ex-US, and across emerging markets. So what you see is a outperformance on the left side. It's a really consistent pattern. All right, so let's move on. So maybe to sort of like conclude the equity part, I've done it relatively quickly because I want to make sure that we can talk about the stuff that I think I know a little bit about. So what gets you to essentially a good outcome? So what are the recipe to success there? The first one is that working with advisory firms like yourself ensures that you as an investor are able to decide upon an investment plan that matches your goals and risk tolerance. Then the second part is that diversification of your portfolio is obviously very important in addition to minimizing costs. And most importantly, a good approach should give an investor the confidence to remain calm and disciplined through volatile markets. And let's agree that we've seen quite a bit of that earlier this year. So it's stay cool, stick to a process that you believe in and a philosophy that you believe in. That gets you generally to good outcomes.
Yep.
All right,
Thank you, Joel. I mean,
I'm gonna take a quick break there before we move to fixed income.
Yep, sounds good, Joel. Thank you so much for that. It really encapsulated what Dimensional is all about, and the investment process that you guys espouse in a systematic, evidence-based way. And this, focus on what you can control is exactly where Endowus comes in. We really want to guide investors in doing what you can in the areas you can, but even, we cannot control COVID outcomes. We don't know where the economy is going to head. We don't know what markets will done. But also, Joel, I did want to ask you, we also cannot control when the factors will show up, right? Because many people talk about these value factors and small factors and how they've underperformed. And, they underperformed massively earlier this year. And then very recently, they've made a tremendous comeback. And so even when the factors actually outperform, it's really difficult to predict. It's something that we cannot control, right?
That's exactly right. Which is, again, that goes back to the principle. Make sure that you own that very well diversified portfolio, because it's so difficult to time not only the market, but also the premiums that we pursue. So if you own the market, there may be some tilts. You're definitely positioned to, when the premiums show up, you're going to capture them. And as you know, Sam, investing is a long-term game. It's not about what happens tomorrow. At the end of the day, it's working towards a longer-term goal, the goals that you define with your clients as what they will need when they retire.
Absolutely. Great points. So I want to, before we move on, there is a quick question on Slido about, how Dimensional announced some ETFs. And, we know that it's not available here, but maybe, and it asks, how does that change the relationship with Endowus? It actually doesn't change the relationship, but maybe, a quick, update on that for the audience.
Obviously, the focus of at this point when we talk about these ETF launches are mainly on like our home, like the home market, the US. It's a US firm, so US ETFs. I'll be very brief about this. At the end of the day, ETFs are just a different way to deliver the same investment experience, but in a different vehicle. So at the end of the day, in these ETFs, they're not passive, they're not index. And so what we try to deliver is the same insights into like the premiums that we know exist in markets. So in a way, they're actively managed ETFs with exactly the same features as that we have in the funds.
Yep.
And
And I think
there's
it's a
certain advantages in the different types of vehicles, taxes, too many things that we probably can't cover in this particular webinar.
yeah. But for the audience's sake, I think it's important to highlight that people think ETF equates passive, equates index investing, and that's clearly not true, right,
Exactly.
Joel?
That's one way to do it. And there's obviously a lot of that out there. And in my previous shop, the one that you already mentioned, they've grown quite big with delivering those type of solutions. Nothing wrong with that if that is what you want. But in the case of like the ETFs that we are in the process of launching or have launched, they definitely align with the investment products that we already have.
Yeah.
Yeah.
That's great. So know what you're investing in is know that there are active non-indexed, ETFs, or active indexed ETFs. There's passive ETFs. So know
There's
what you're investing, because there's
lots
more
of
ETFs
different
out there than
flavors.
stocks, right?
That's exactly right.
Yeah. Okay. So let's move into the fixed income portion.
All right. So I'll be relatively quick about the first part because it is a little bit repetitive, but let's and then we get to the media part as in like, how did we do? What exactly do we do as a portfolio manager when we manage a fixed income portfolio? Now, I just want to spend a few minutes about this idea about, like I've mentioned, like trust the markets, like what exactly does that mean? So in our view, when we think about well-functioning markets, when securities, in this case, fixed income securities, get traded. So this is a daily process of people buying and selling based on new information that is available. And every portfolio manager or credit analyst that will trade on a particular set of like new information impounds that information into the price of that security. So people know us as that we're in a way quantitative and model driven. Yes and no. Yes, in the sense that yeah, we believe in models, but the least incomplete model is price, because it's that model price gets adjusted every single minute when new information reaches the market. So that on itself also gives you an idea about investors who try to outguess market prices. They're basically competing or pitting their knowledge against everybody else, the collective wisdom of all market participants that have been trading these securities today. So we take a slightly different approach to that. We believe that the price of, in this case, a bond is the most complete model out there. And there's information in that bond price that we can use to improve returns, but also manage risk. Now, that sounds very abstract. I'm going to like explain that in a little bit more detail as well, what exactly that means. Now, let's move on to the next slide. Very similar pattern. So I know that there's a narrative like, yeah, fixed income markets are, we get it for equity markets, but fixed income markets are a lot more inefficient. And on the back of that, surely active management should be a lot easier to actually beat the benchmarks that you've got out there. But when you do the actual analysis, then the actual outcomes are fairly similar to what you see in the equity space, that actually not that many fixed income managers are over longer periods of time actually successful in beating markets. So you actually get to a very similar outcome. And the next couple of slides, if we can move on, basically show you the same thing as what we've shown for equities, also for fixed income. Costs matter, fees matter. Moving on. Persistence of like successful managers over the past 5 years, are they still going to be successful over the next 5 years? A bit better, but not a lot better than what you see in the equity space. All right, let's move on. So let's move on now to like, yeah, what is it that we do at Dimensional when we talk about fixed income investing? So I'll try to get it out of the abstract, but essentially we structure portfolios along duration dimensions, along credit quality dimension, and along currency of issuance. Now, what exactly does that mean? In normal language, it means that we actively manage the duration of the portfolio. We actively manage the credit quality in a portfolio by allocating to different degrees of credit risk, different credit rating buckets. And we make active decisions in terms of like which bond markets do we want to tilt towards, to which markets do we underweight. Let's move on. And so to flesh that out a little bit more, when you think about like, what is it that you do on a day-to-day basis to actually add value in a portfolio. And I'm going to simplify it here. If you look at the 3 different columns, it's getting returns, in the middle, managing risks, and the third part is managing costs. And a lot of that is happening in the trading process. Now, I'm going to flesh that out a little bit. Let me start a little bit with returns, and then the questions that you had, Sam, that you posted to me. As you know, earlier in the year, especially for credit and fixed income, there were a lot of concerns about 2 things: credit quality, fallen angels, defaults, real credit risk. And the second one is illiquid bond markets. There's no liquidity, very difficult to trade, very high trading costs. Now, the second and the third part of like what I show here will directly address those questions, but we can't go there before until we've said a little bit about like how do we try to get these higher expected returns in a portfolio. So let me talk a little bit about that. I'll try to make it as brief as possible, but there's some interesting stuff in there. All right, let's move on.
And Joel, let me ask the question and then you can answer it so that the audience can hear it. Yeah, great, thanks.
Interrupt me. The next 2 slides are maybe a bit tough, but once we get through the next 2 slides, they're probably the most 2 difficult slides, but they will hopefully clarify a little bit as in like, yeah, what exactly is it that we do? Because in a lot of cases, clients understand what we do in equity markets, but it's less clear what we do with fixed income. Now, I'm going to start with a very simple example of like thinking about like what drives returns, what drives bond returns. We start with like a simple decomposition of like, yeah, what are the key components of a holding period return in a bond? Now, we use a yield curve here. We use it as an example when you think about a holding period return. Assume that you buy a bond today that is a 5-year bond, and assume that you hold that 5-year bond for a 1-year period. Now, what are the components when you think about the price path of a bond that you can distinguish? Now, the first one that you undoubtedly will come up with is yield. Yield is obviously an important part of like a return of a bond. Now think about that 5-year bond in a year's time is going to be a 4-year bond, and think about like a basic valuation principle is discounting cash flows against the discount rate. Now for stocks, that's obviously dividends, and you have a discount rate that you apply, and there's your price for the stock that you hold. For bonds, it's the same thing. The cash flows are the coupons. Eventually, you're going to get the principal back, and the discount rate is the yield. Now, what is the key thing that you get out of this when you look at a yield curve? A 5-year bond obviously have that 5-year yield as a discount rate. 4-year bond will have that 4-year yield as the discount rate. And if you then understand that the 4-year discount rate is lower than the 5-year discount rate, it implies that you're going to get a capital appreciation on the back of the shape of the yield curve. So I'm not going to dwell too much on that. The third part is essentially the fact that the yield in a year's time is not going to be exactly where the 4-year yield is today. Now, this is the crux. Yields can change. But what most of the industry does, including myself, like what I've done for 20 years, is trying to forecast where that 4-year yield is going to be in a year's time. Now, that proves to be very difficult, and hence we don't emphasize that. If there's managers that are good at doing that, fine. We basically look at like those first 2 components, 1 and 2, what we call the roll down. Is there enough information in those 2 components that we can use to earn the premiums, to harvest the premiums in a fixed income portfolio? Now, 1 and 2, we can calculate every day, and they're called forward rates for people who have studied finance. Now, very quickly, if we move to the next slide. There's a lot of data here, but hopefully this clarifies a little bit as like, yeah, where do we fit in when people talk about factor investing? Where does it link into fixed income? So essentially, this is one example where we look at research, the research that we do, and where we test whether variables actually work. And those components 1 and 2, the forward rates that we talk about, in tests show up as very reliable, and that you can use them to actually earn term and credit premiums. The bunch that we have below are variables that are typically used in equity, in the equity space. So for example, we've tested profitability, we've tested leverage, for instance, company size and so forth. While it works for equities, it tends to work a lot less well in fixed income, and hence we focus on things that we can directly observe the forward rates. All right, that's enough about the conceptual framework. I know this is quite tough. Let's just move on what the implications are for like how we manage portfolios. So essentially what it means, bonds with high forward rates, if forward rates are high, if that combination of yield and roll down is high, it means that you probably should be extending the duration in your portfolio to the part of the yield curve that is very steep. So if yield curves are steep, we buy more duration in a portfolio. When yield curves flatten, we reduce the duration in the portfolio. Very transparent. If you look up like what a yield curve in the US looks like, you can sort of guess what we will do in a portfolio, in a fixed income portfolio dimensional. Let's move on. We can apply that same principle across different markets. So that's, for instance, in the bottom of this exhibit, we know that yield curves across the globe typically don't have exactly the same shape. So for example, foreign currency A could be the European bond market, while foreign currency C could be the Japanese bond market. Now, what follows from this is it's quite likely that you're going to earn less premiums in Japan. So hence we would tilt away from that. And we move more in markets that have steeper yield curves, where you get more of that combination of yield and roll down. All right. So that's how we invest globally. Then the last bit, when we expand into like investing in credit and harvesting credit premiums. So let's move on to the next slide. Is basically a very similar principle. If credit spreads are wide, it typically means that in the future, you're going to harvest higher credit premiums. There's more risk because at the end of the day, that wider credit spread tells you something about risk. But think about it this way, Sam. In periods where there's more risk, typically people become more risk averse as well, right? And for a given level of risk, you're basically going to say, I want to earn a premium. For that higher volatility or the more uncertainty in the marketplace, you got to reward me for that. Otherwise, I'm going to buy a risk-free security. Now, there's a time variation in these credit premiums that you can earn by being disciplined in applying the approach that we have. Now, you may think, yeah, great. What's so special about like buying credits when credit spreads are wider? That doesn't sound very sophisticated. You increase risk in the portfolio as well. So that next section, Sam, that ties into like the questions that you had, like what do you do with risk in a systematic setup? We don't have credit analysts. There's no people that try to figure out what debt to EBITDA for a particular company is, or it's going to try to figure out what free cash flows in five years is going to be. So what is it that you then can do with data, with a data-driven approach, and still manage these sorts of like essentially idiosyncratic firm-specific risks in a fixed income portfolio? So we'll talk a little bit about that if you're interested in that. And let's move on.
Yeah, that'd be great. Yeah.
And that will directly tie into like the experience that we've had in March. If we can move on.
Yeah, just for the sake of the audience, I did ask Joel to, touch upon the experience in March. So this will tie really into that, and how Dimensional managed the funds and fixed income portfolios through that cycle, right? And volatility.
That's exactly right. Because normally if you would have asked me in my previous job, we probably would have spoken about the outlook for fixed income markets next year. We don't do that at Dimensional. So instead, I want to give you a better understanding of like what we do. And what you will see is that we get to really good outcomes, and that we manage risks in a really robust way. So let me actually move on to like that topic that you see there, real-time credit monitoring. I will show you a couple of other things that are there. All right, let's move on. And this also goes back then later to like trust in the markets and using information that you can directly get out of the marketplace. Now, let's talk a little bit about risk and credit risk. When you talk about credit risk, how does that manifest itself? Now, this is data, and I'm not going to spend too much time on it. But clearly, one of the risks is that you own a single A rated bond today. Bad things happen to the company, it gets downgraded to single A, or maybe even triple B, or it gets downgraded to double B, to high yield. Now, the data that you see here in this matrix, this is what you call a credit rating migration table. So this is nothing more than statistical data that Moody's or S&P can get for you. And essentially what you see here is along that diagonal, you see from AAA to AAA, for example. Now, what that says is that over a year's period, what is the percentage of AAAs that after that 1 year is still AAA? If you then move to the right, is you see that percentage of AAA rated bonds that after 1 year have been downgraded to AA, or even single A, which is 0.6% in this exhibit. So you can go along this diagonal from like credit ratings from the top down, and you see historical evidence of companies that sometimes get upgraded, but in a lot of cases also get downgraded. We're obviously talking about managing risk here, so we're looking at downside risk. Now, what is the ultimate risk? That is the one that you have at the far right, is that you don't get your money back at all. Or you get some of it back because the company gets liquidated, and hence you're going to get a recovery value for that default risk. But that's the ultimate risk, but obviously by the time you get a downgrade from BBB to BB, the price of the bond will go down as well, because the market is going to price in that it's higher risk. Okay, so now what do we do with those concepts around downgrades and managing this type of risk? Let's move on. So what we show here is an example of a company and the real experience of like that issuer over the last 10 years. Now, for compliance reasons, we cannot show the name of the company in the slide, but I'm going to tell you, this is Nokia. Now, I don't think anybody has a Nokia cell phone anymore. So that probably explains a little bit what has happened with this particular company. Now, let's start with what Moody's and S&P have told the market as what the credit risk will be. That's a solid green line. And what you can see is that it started as a single A rated company. It got downgraded to BBB, to BB even, high yield, and then all the way down to single B before it recovered a little bit. Now, an index investor, Sam, you can imagine, is simply going to list the Moody's and S&P. If you have an investment grade portfolio, you're going to get that out of the portfolio in July 2012 by the time it gets downgraded. Okay. Now, how do we then see if, is that a good way to like approach it? What does the market tell you about risk? Now, the only thing that we've done here is overlay the credit rating evolution with what is the way to like look at like how the market appreciates credit risk, the credit spread. What is it that you see here? Power of markets. Markets absorbing news very quickly are reflecting it. The credit spread widens out well ahead of the actual downgrade. Now, I can do two things here. In my past, I would have said like, well, in say August 2010, let's start at the left. That credit spread starts widening out. This looks really cheap. Value. The critical point here is that similar to making duration bets is you need to come with the right directional view. Is this cheap? And is the credit spread going to come back in to where the rating is? Or do you correctly predict that specific company gets downgraded all the way to single B? And this is a standpoint that we take. Maybe there's people that are good at it, individuals, but by and large, across the full universe, a lot of people are not that good at making these sort of bets. So what is it that we do? Let's move on. So let me explain this with this exhibit and like what is it that we do in a data-driven way. So let's start with the fact that obviously lower rated credit typically tends to trade at wider credit spreads. So on average, BBB rated bonds trade at higher credit spreads than single A rated bonds. So this is what we call spread curves. Now, what happens in situations when we see a particular company? So we download this data every day. For every individual bond, for every issue, we'll look at like what do credit spreads do? We get this out of multiple data sources, CDS, transaction-based data, quote-based information, lots of data sources. Essentially, what we try to do is find names that still have a single A credit rating assigned by Moody's and S&P, but where the market tells you their assessment of risk is different. So look at that single A rated company that now starts trading as a BBB rated bond. This is why we diverge from a fundamental approach where we say, well, we're not going to see if this is misvalued and maybe this is cheap and let's buy this because we get a much higher credit spread. And we say, well, the bulk of the people who have been trading their bonds feel this is BBB rated risk. And what the table at the bottom shows you is that that pattern is quite consistent across all credit ratings. And so just to get an example here, 15% of single A rated bonds really trade like BBB. 11% of BBB rated bonds really trade like BB. All right. So this is how we internally assign credit ratings. And it's okay, that's fine. Does it work? What's the impact of that, like when you apply that principle in portfolio? So let's move on. So this is one way to express it in terms of price performance. So say you own a triple B rated bond, and then we can look at different groups of triple B rated bonds at the time when credit spreads widen. Now, triple B rated bonds, if we start from the far left, that trade in line with the official credit rating, nothing wrong with it. They actually give you a positive return. But if we move down to like that spread above the midpoint, that triple B rated bond that really starts trading more at yields commensurate with double B, starts trading like double B. And when credit spreads widen, the price of that bond will actually go down. Okay, so if we move up then, and now we link it to like the credit rating migration data that I was talking about before. So if we look at that solid line now, throughout time, we know that when you go through bad times, the downgrade frequencies go up. If we then look at the gray dotted line, that's exactly the part of the market that looks cheap. You see through bad times that these downgrade percentages go up very significantly. So this is one way to avoid what we call the value trap. Things that look cheap, but are priced by the market for a good reason. Okay, so how has that worked now in, say, earlier this year, in March and April? So let's move on to the next slide. So there's a bit of data here, but I'll talk you through this. So this is over the past 10 years where we've been applying this approach, where we internally assign credit ratings and we downgrade and upgrade credits. So we only look at whole letter downgrade. So we don't notch it like triple B plus to triple B flat to triple B minus. We look at whole letters from single A to triple B and so forth. And what you see then is that the total downgrades were, for example, 533. What is directly below that is the downgrades that we applied purely driven by price. So use the approach that I just showed you. Then, and what that shows is when we look at the percentages, that in 63% of the cases, we were ahead of Moody's and S&P. When we look at year-to-date 2020, that percentage went up to 79%. Now, in the other cases, for things to total up to 100%, either Moody's or S&P was ahead of us. Now, if we look at this as a very frequently asked question, let's zone in on the triple B rated companies or investment grade companies that were downgraded to high yield, real risk. And we show the same data, but now for that part of the credit market in the bottom half of the slide. And see quite consistently that the scores there are even better. Over the full 10-year period, we were ahead of rating agencies in 85% of the cases, and it went up to 86% in the beginning of this year. So this is a good test in a stressed environment where your process actually holds up. Okay, so one example of like a data-driven approach to manage credit risk, and I could give you multiple more illustrations, but hopefully that gives you a bit of an insight of like the risk management part.
Yeah, that's wonderful, Joel. And I know that it's a little bit complicated, but I hope that our audience is following with us.
And,
but maybe we can just go back to that Nokia, chart, and I think it'll be good to take a look at that and ask you a question related to this whole active passive, because here, if you followed the rating agency, you would have been really behind the curve, and that's what a passive index investor in fixed income actually does. So the question is, we poo-poo the active guys because 70% plus underperform. But is passive worse? I mean, systematic, dimensional way of doing it is the best, obviously. And after that, is it active or is passive better? And this chart seems to suggest that passive may be the worst of both worlds.
It's difficult to say. I mean, if you have the special talent to pick the best active manager that will always outperform, then you should go with that approach. So I'll leave in the middle of like whether.
No. But how poor is passive investing?
Yeah,
like the
so there's
index,
obviously advantages.
Following this rating agency model. Yeah.
Well, there's disadvantages to that. I mean, the advantages. I don't want to completely talk down on like passive because at the end of the day, you're partially saved by the fact that you have that very well diversified portfolio. So there may be a couple of like bad apples in that index portfolio, but because you own so many other things, But how we approach it, yeah, we're trying to get meaningful diversification as well,
Yeah.
similar to an index approach, but then do a little bit better on like managing the negative tail that we know that exists in credit markets. There are a few bad apples that can really ruin the performance of your portfolio.
Yeah.
And that's
But the other
exactly the
thing,
point.
yeah. But the other thing, Joel, maybe is that, you know, the power of markets and how information is embedded in the price of securities, whether it's equities or fixed income. And
Yeah.
this clearly shows us that actually the market gives you more information, allows you to systematically harvest, you know, returns that are better than passive by being systematic and really
Yeah.
looking at the pricing, right? So that's
That's
great.
exactly right.
Yeah, and just a couple of questions from the audience I want to touch upon. And I know you have some slides on trading and execution, but let's
Yeah,
just assume dimensional is fantastic. And in the interest of time, since we've already passed 8 o'clock and we started a little bit late, is it okay to skip that part and maybe
absolutely.
focus on the question that is on everyone's mind? We already have two about what role does fixed income play in an asset allocation in this low interest rate environment, with yields collapsing, with debt monetization? Will bonds continue to behave the same way, you know, provide diversification benefits in a portfolio? So, you know, and how do you invest in a low or even negative interest rate environment, because we're already there, right? And I know you have some slides, maybe we can jump to that as you
Let's move
answer,
to
but
the section.
yeah.
So we've got to move on a little bit. I don't know the exact slide numbers here, but we keep going and
Yeah,
get past at this point. Yeah.
sure. So we have some slides on the execution part. Maybe we'll do a whole section on another webinar on
I've been
how.
talking too much, and I probably should have been a little bit quicker about some things, but
No, this is great. It was really helpful. But investing in low rates, perfect.
all right. So at the end of the day, there's no magic involved. What we do as a dimensional, we can't make yields higher than what they are. Let's all agree that yields are very low, and there's obviously markets that have negative yields right now. So we can't change the market, but the basic point is that our approach in terms of doing better than that market, there's nothing different there. So the approach that we have that we apply, we've done the research in periods where yields went up. We've done it when yields went down. So obviously prices are yields are quite low right now. But that same approach where we look at yield curves, which market is going to be will deliver higher expected returns, which part of the yield curve should you invest in to achieve those higher expected returns, that is exactly the same. I'm not going to go into like this particular example, but again, the principle still applies that yield curves that are steeper typically deliver higher expected returns, so we would emphasize those. If we then move on. And this is another thing that is maybe a little bit technical, but it is relevant that in some of the portfolios that we have invested, that we manage, you would see European bonds. We get lots of questions as well, like, why would you invest in bonds that have negative yields? Now, this may actually be a good example where, say, local currency in this case, so say you live in Singapore, and that local currency yield curve is a Singaporean yield curve. Admittedly, also not that high, but the green line could very well be the European yield curve. Now, typically what we do with fixed income portfolio, Sam, is that we try to take out currency risk. Because in a lot of cases, clients don't want to get the volatility of all these currency movements in the part of the portfolio that should be relatively low volatility. So what happens, don't want to get too technical, so I'm going to keep it graphical here. And if we then hit go, then I think what you will see is by the time you hedge the European denominated bond to Singapore dollar, this is what happens with your expected returns with a hedged yield curve. And all of a sudden, because you hedge that currency risk, in this case, for instance, through a 3 months currency forward, that European bond actually in total return, including the hedge, actually gives you a higher expected returns than Singapore dollar bonds. So if you want to look this up as how this works, this is what is called covered interest rate parity. But essentially, this is how we assess investment opportunities across global bond markets. And it sometimes leads to results where people say, it's like, hey, I don't understand this. By the time you explain it like this, we can still improve things a little bit from admittedly low yield levels that we see globally.
Yeah, and it's interesting actually, Joe. We have a question about the Sing dollar hedging and how that works, and how that affects equities
well, this would be a
versus
good
bonds.
example of like how that would
Yeah,
work. Yeah.
precisely.
And
So
so
this
think
is a
about the
great
principle
thing.
as if I invest in a yield curve with much higher interest rates than my home market, the hedging will cost you money. If I invest in markets with lower yields than what we get in Singapore, you're going to gain through the currency hedge. That's basically the idea.
That's right. So low yielding in Europe, and there's a lot out there in the world, right?
What you
Which
want to
have
see
low
then
yielding.
is that the yield curve needs to be steeper, exactly what
Steeper.
this green line is relative
That's
to
right.
Singapore. Then it makes sense to do
Okay.
it.
So lower yielding currencies with a steeper yield curve are the way
You
to
got
go.
it. That's
right.
exactly right.
Fantastic. And is there a difference? I mean, I can just share that, the question is asking about the difference between equities and fixed income when you're currency hedging. And obviously for equities where traditionally there's a lot more movement and volatility, is more difficult to hedge. But is fixed income currency hedging a much more systematic and better process that will yield better outcomes, do you think, Joel?
Yeah, I think there's a bit more accuracy as in like how the hedging works because the reality is in equity portfolios, the actual risk profile gets dominated by equity risk anyways. So whatever currency volatility you're going to see there gets completely dominated by like other risk sources. For fixed income, it's the opposite.
Right, that's great. Do you have anything more on this part, or should we move on to the next topic, the final topic that we have, which is managing risk, through volatility, especially through March? I think you have a couple of slides at the end on that too.
Let's move on. We can have a quick look at this. Basically, is what I already addressed. And this is one way of us saying that even there's always a lot of like focus on like what does the Fed do, and a lot of focus on short-term interest rates. This is one way of showing that if you look at a particular market, like for example the US, there's a wide dispersion between yields and yield movements on different maturity bonds, even within a single market. And if we then move on, so this is another very well-known phenomenon. We've been at close to zero rates for like more than a decade in the US, with a short period between 2016 and 20 where interest rates went up a little bit. But by and large, policy rates have been at very low levels for a very long period. Does it equate to like fixed income or bond returns being a zero during the period too? No, if we then move on to the next slide. So throughout that period of very low policy rates, actual bond returns annualized have been just south of 4% throughout that period. So there's still multiple things, so multiple levers across that bond universe that we can pull to get better than the main interest rates that people tend to like focus on. Okay. Yeah, so I'm going to leave it at that. These were a couple of examples. So again, there's no magic. We can't make yields higher. By and large, we don't feel that the role of fixed income in diversifying the risk that you have in an equity portfolio, that should still persist.
Yeah, maybe the two slides after the market's response to crisis, and we look at how 60-40 portfolios have performed.
So
and
maybe the
you can
one
comment on
before
this
that
one.
is
One before.
typical question that we have about like, how about QE?
That's right.
Are things different now? So this is basically one way of like looking at that, and the percentage of US treasuries that are held by the Fed. So they own a lot, but they've traditionally held a lot before that as well. So again, when you think about like markets that function well and that prices are a result of people buying and selling, the Fed is one of the buyers, albeit a very large one. But at the end of the day, they help determine where the price is going to be. Okay. That's basically that point. And then the last one exactly is about 60-40.
Yeah, just before we go there, one last question from the audience is, a typical question that we receive all the time, which is, in the longer run, how soon do interest rates are expected to rise back? And would that pose a risk to bond prices as a whole? It doesn't matter to dimensional.
Right? Well, at the end of the day, it doesn't matter. But the real question is can we correctly predict and time when exactly that is going to happen?
Yeah. The rate of
very
interest rates and the yield curve, the shape of the curve does matter, right?
That matters, and we can observe it every day. The difference is we don't try to predict what will happen tomorrow.
That's right. Okay,
that's the difference.
Got it. Yeah. And then let's wrap up in the interest of time with this chart and how fixed income plays an important part still during crises.
Yeah, and essentially what we say, well, you know how we talk about correlations, Sam. We don't really put a lot of weight in historical volatilities or historical correlations because they can flip. Over longer periods, it's probably fair to say that the correlation between stocks and bonds is zero. But that's not obviously not all the time. So in periods where you have very high equity volatility, what you typically do deserve is that these correlations will flip negative. So at periods like that, this is exactly why you hold bonds in your portfolio. They will provide the diversification that you need. Then the other thing that you know about us is how we think about asset allocation and, for instance, tactical asset allocation. If we don't forecast what will happen with stocks and bonds, we're also not going to say, well, we know better than everybody else. This is the time that you should be overweight equities relative to bonds. So in a lot of cases, just holding that 60-40 portfolio will get you in a pretty good position as long as you have an investment horizon and you have the patience to go through the occasional bout of volatility and bad times. And that's basically the message of this slide. I think that pretty much aligns to like how you guys think about investing as well.
Yeah, fantastic. So we'll stop sharing the slides and wrap up here.
Thank you, and apologies for like taking more time.
No, it was fantastic. I think we went through a lot of content, and I think the audience benefited greatly from hearing from you directly about how Dimensional invest and your professional experience. And we're not trying to predict the markets. It's something that we cannot do. It's amazing how individuals as human beings, we would never say that we can predict the future. But when it comes to financial markets, for some reason, we think that we have this clairvoyance that, we can predict where the markets will go, right? Isn't that
exactly
amazing?
Right. Yeah.
So with that, I want to just wrap up and thank you, Joel, for joining us today and giving us, deep insights into Dimensional, how you invest, and also the fixed income markets. So last words from you, Joel.
Well, thank you for having us. And again, we value the partnership that we have with you. So hopefully we get to come back and do more of these going forward.
Yep, fantastic. We will for sure on more interesting topics as well that will, meet the needs of our audience. So Absolutely. Everybody, thank you so much for joining us today. We'll be back with new great content. We'll have Dimensional back. Maybe one last question I forgot to ask, which somebody asked earlier was, is Dimensional coming into CPF? Is that something that you can comment on?
We're working very hard on that, Sam.
Okay, fantastic.
We hope to give you good news very soon.
And the sooner the better, right? So fantastic. Absolutely. Thank you, Joel, very much for doing this today with us. And thank you, everybody, for joining us today. Have a good evening.